Hey guys, what's up? Alec back with the daily stock market, and today we're going to be talking about a very quick video. It's going to be Microsoft versus Sony versus Nintendo. And it's mainly just going to be Microsoft versus Sony because those are the two big ones, but you might be surprised with Nintendo. That's why we're actually going to throw it in there as a little bit of a curveball. So make sure you smash a thumbs up on this video if you are appreciating these daily videos. And let's get right into the video. First up, we have Microsoft at about $250 currently. It hasn't moved really much in the last month. In the last 3 months, it's only up 2%. But in the last year, it is up 35%. Now, it looks like our current support is like 235 to 243. So I would say anywhere between 200 and 250 is a good place to buy Microsoft if you're looking to get in them for the long term. As we scroll down, you can see I have a very small position. I just started it, and I'm going to be continuing to build it. The market cap is huge, almost a $2 trillion company with a 33 PE ratio, which is not bad, and a dividend yield of almost 1%. Now, if we pull up Sony, it's sitting right under $100, right? And it's down 12% in the last month. So we have a bigger downward movement, implying that it might be better for a deal in the short term and also good for the long term also. So this one, I would say under $100, between $100 and about $100 to $80 is a great place to buy Sony if you can get in. I just started a small position in Sony also, looking to grow it. Look at that PE ratio. It's only 10, implying that it is a great deal in the stock market and one you should definitely be considering, Sony. And the reason why I picked these two stocks, Sony and Microsoft and Nintendo 3, is because a lot of people have growth stocks 100% of their portfolio. And those are the fun, exciting ones because everyone's talking about them. But you want to balance your portfolio and have a good percent of blue chip, stable, safe stock. So if you want to see exactly what I'm investing in, by the way, I actually rip open my portfolio, my IRA, my Roth IRA, and my SEP IRA, and see how much percent I have going to each stock. So for example, it'll be like 15% to this stock for retirement, 20% to this stock, and so on and so forth. I have a whole pie, and there's about 14 different stocks in my Roth IRA and about 12 or more in my SEP IRA too. The cap is only 126 billion, so it's literally like a tenth of the size of Microsoft. And if we're looking at Nintendo, they're at $70, $69 exactly, and it's down 4% on the day, 4% on the month, 6% in the last 3 months, and the last year it's up 30%. So I would want to buy this one around $50 a share. Anywhere between 50 and 65, I think, is a great long-term position. If we scroll down, they only have a 16 PE ratio, and again, implying it's a really good deal. It's about half the size as Sony, and the dividend yield, look at that, 2% dividend yield. Let's actually buy 250 of some Nintendo right now. Let's look at the financials of these companies to see which one is the superior one. So Microsoft, you see that they have been growing by double digits on their net income every year. They're up to $44 billion in 2020, and their revenue has been growing double digits for the last 3 years, and they're up to $140 billion in revenue. And I'm sure they're even doing better now if we click income statements and read one of their more recent ones. Their Q3 at $41 billion in total revenue just in one quarter, right? And if we scroll down, we can kind of see their net income, $15 billion just in one quarter, which is a 43% gain on net income just in year over year, which is absolutely ridiculous. And that's a great sign to see that they're doing 15 billion just in one quarter. If they keep that up, that's going to be about 60 billion on the year, which would be another double-digit gain. So Microsoft's looking very good when it comes to net income and total revenue, which are two very important things. The next thing we have to look at is their balance sheet. Their balance sheet actually looks pretty good for a big company. You know, they have 300 billion in assets and only 183 in total liabilities, which is about a 60% ratio. I like it a little bit lower. I like the ratio like below 50, and if you can get it to 25, is even the best. So they are holding a lot of cash and cash equivalents, and it's up 17% year over year to 13 billion, which is a really great thing. And their other current assets are up 36%, which is another really good thing. Long-term investments are up 102%, which is phenomenal. But if we scroll down, and it looks like their long-term debt, which I wanted to scroll down and look at, long-term debt is down 13% year over year, which is a good thing to see that on a company. Overall, it's going to be pretty difficult to beat a company that's growing net income 20-30% a year, total revenue at least double digits, and have a solid balance sheet, very cash heavy, and becoming more positive in cash and cash equivalents, and also paying off their long-term debt. Next up, we have Sony. We have their net income pulled up. And look at that. They're very fluctuating. So they grew by 69%, and then they're down 33%, and then they grew by 85%. So they're not as steady and not as reliable as something like a Microsoft. Also, their total revenue is not growing by double digits, which is a big red flag for me. And if we look at their balance sheet, I'm not a fan of their balance sheet because they have almost as much liabilities as they do assets, which you guys know I do not like. Their cash and cash equivalents is up good, and short-term investments is up good, which is a good thing. Their total assets is up 10%. That's always a good thing. And their long-term debt is up 17%, guys. That's a bad thing. So remember when we pulled up Microsoft, their long-term debt was down. Their total current liabilities are down. So overall, Microsoft is dominating Sony, in my opinion, in which is a better stock. I would give Sony like a C, and I would give Microsoft like an A. So it's that much of a difference. But now let's pull up Nintendo. So we have Nintendo's net income pulled up, and look at that growth, guys. It's very steady, it's very consistent, and it's going up 40 to 30% every single year, 2.4 billion in 2020. Now, if we pull up their revenue, it's also growing by double digits. 2019, it wasn't quite there, but they stepped it up in 2020. And let's look at more current. So they were doing 2 billion in 1 year. So let's look at the most recent quarter on net income and compare it to the full year of 2020. So if we go to net income, scroll down, they did 1.5 billion, which is about 6 billion. So that means they're on track for 6 billion. Couldn't possibly be a triple digit gain on net income in 2021 if Nintendo keeps it up. Now let's look at their revenue. They did 12 billion in just 2020. So if we look at revenue, in 1 quarter, in the most recent quarter, the Q3, they actually reported 6 billion in revenue, which is up 15% year over year, which means they're on track to double their revenue in 2021, which is a really good thing for Nintendo or any company, doubling revenue, but that means they have to keep it up. So here you see they did 9 billion, 10 billion, 12 billion in 2020. And then if you look at the most recent quarter, they actually did in Q3 6 billion in total revenue. And if we scroll down to net income, just to recap, they did 1.5 billion in net income. So they're growing very tremendously. And wow, look at that balance sheet. This is why I really love Nintendo, guys. They're growing. They have potential to even grow triple digits in total revenue, and a net income can continuously grow even 30-40% a year. But their balance sheet is phenomenal. Look at that. They have 17 billion in total assets and 3 billion in liabilities. That's it. So they have like 5 times as much assets to liabilities, which is one of the biggest things I look for is a balance sheet when I'm looking for a safe investment on my money, because I know that that company can easily pay off any debts that are coming its way. Now, what we'll see is their cash and cash equivalents is 10 billion and their liabilities is only 3 billion. So they can easily pay off all their liabilities with their cash and cash equivalents. Now, if we scroll down, actually, one thing to note is their short-term investments is up 86% year over year, which is very good for the company to show that they are investing. Total current assets are up 35% on the year, Total assets in general are up 29% year over year, and accounts payable is up 25%, which is good because that means that they have like a reoccurring, maybe their network, their online to play their video games are up or something like that. Now their total current liabilities are up 57%, so it's actually 5 billion now. So instead of that 3 billion total liabilities, let's currently see what it is at. Let's see, total assets. Total liabilities is 5.7 billion now. So it has gone up, but if you look at their total assets are now 22 billion. So their total assets also went up from 17 to 22, and their total liabilities went up from 3 to 5 billion. So it's still the same ratio about, which is very, very good. So overall, if Nintendo keeps up what they're doing, I would give them an A+ as a stock in a company. Net income is amazing. That's a huge thing. They're a profitable company, and they're growing their net income. They're growing their total revenue, and they have a phenomenal balance sheet. So guys, if you like when I do quick breakdowns like this on stocks, give me some more stocks to compare against each other, and I'll be more than happy to do it. Look over their balance sheets, their income statements, and if you want me to do even more of a deeper dive, we can also look at news articles and what analysts are saying about each of these stocks is the next step. So let me know if you like these deep dive videos where I compare some stocks against each other and go a little bit more on the fundamental side and do a deep dive, because I do enjoy making these videos for you guys. I know a lot of you guys like the quick videos also where I rattle off 5 or 10 different stocks, so don't worry, I will always keep making those videos for you guys. On Sunday, every single Sunday, I release my watch list for the week with price points involved in that video. So make sure you are subscribed with post notifications on so you are getting alerted as soon as I post a video. And if you want to become a member of the program and see exactly how I invest and what do I invest in every single day, reach out to me here on Instagram. We're consistently growing. We're now at 200 posts on Instagram and 150 posts on YouTube. So we're growing every single day. We're almost at 100,000 followers on Instagram, and we're going to be doing a $100 giveaway on Instagram too. So make sure you are following me on Instagram and subscribed on YouTube to be eligible for that $100 giveaway. Also, it's going to be going to someone who comments frequently on my videos, YouTube and Instagram, so keep commenting below. Even if it's just a fire emoji or your thoughts about the video, that does go a long way. Thank you guys so much for the continued love and support. I hope you enjoyed this video, and I will see you in the next one. Remember, don't time the market, buy the market. Peace.